Assets turnover ratio tells us the turnover generated by assets of the business, total assets of the business. We need two figures for this ratio. Turnover, which we have already used in a few profitability ratios, so we know what it is, and the total assets ratio, total assets figure, which is available in the balance sheet. So going to my Excel, assets turnover, I need turnover, which is up there 698.2 and 10622 divided by total assets. So let's go to our statements. And right in the middle of balance sheet, we have our total assets. So let's write this down. Fine. So we got 127 for 2017 and 148 for 2018. This means every 100 pound worth of assets of Marks and Spencer, they generated sales of 127 pound in 2017 and 142 pound in 2018. We can comment that the performance is improving in this area because they generated slightly more sales in comparison to their assets. However, we need more data to assess if the performance was good or not. And the way it could be done is to look at competitors' data. What you need to understand is that efficiency ratios, all of the efficiency ratios, the standards are very industry specific. Unless you compare the ratios with other competitors, you can't really make a judgment. Theoretically, this ratio should be 4 times. 100 pound worth of assets should be creating sales of 400 pound. However, this is possible where you buy, for example, you buy a machine and that machine generates very similar products, and there are thousands of examples, but let's say cups or plates or bottles like these, very similar products. So they generate these products throughout the year. You invest £1 million on that machine, and that machine is able to generate sales of 4 million or even more because of the type of the function that asset has. But it may not be the case in other sectors, especially in retail sectors. We can see that if you look at all of the competitors, all of the participants in retail sector, you will see that this ratio will be not as high. And another reason for this ratio to be lower is many retailers in the UK, they tend to own their buildings, which increases their asset space too high and makes the difference smaller. So most of the buildings owned by Sainsbury's are used by Sainsbury's, are owned by them, which means their assets are too high. If they sell those buildings, rent those back, this ratio would shoot up. So when you're making an assessment of the performance, make sure you look at other analysis, another competitors, and try to read between the lines as well. For example, if there's a sudden jump in the ratio, try to assess why there is a jump. So we can also say that this ratio can easily be manipulated. You can do certain things and this ratio would shoot up, but it's still an important ratio because the purpose of the fixed assets is to generate sales. So make sure you look at the competitors' data. The next two ratios should be analyzed together because they look at inventory management, inventory days, which tells us how long it takes the company to sell their inventory. Two figures are needed: average inventory divided by cost of sales times 365, which converts the data into days. So let's look at the first one first, inventory days. Average inventories. The figure for inventories can be found in the balance sheet, SOFP, and you can see that we have these two figures for inventories. The figure given in the balance sheet for 2018 is a closing figure, and so as in 2017. But 2017 figure becomes opening for 2018. So we have, for 2018, we have both figures, opening and closing. Average inventory equals opening inventory plus closing inventory divided by 2. So to get average inventories, you could add these two figures for 2018 and you can find your average inventory, which can be used in the formula. However, in this case, I am not going to do that. And the reason is that the difference between opening and closing inventory is negligible. It's around 25 million, which seems like a lot of amount, but if you take the percentage of the total inventory, it's around 3%. And this will be the case for all of the established businesses. Tesco, Sainsbury, all the established business, they tend to keep a very stable level of inventories. So average inventory will not be needed most of the time. Closing inventory is as good as average inventory. However, there will be instances where some companies, especially those which are growing faster, we talked about Tesla last week. If a company like Tesla is growing too fast, their inventories will increase faster, will change significantly, opening and closing inventories. And if that is the case, then you should take the average by the formula which I just told you. Another reason you could have a significant difference between opening and closing is pandemic, COVID-19. The data in the COVID or pre-COVID would be different than the COVID data in COVID or after COVID. So the chances are you may have to take the average inventories. But the thing is, if a certain data crunching exercise, certain equation, certain formula does not add value to the analysis, we don't do it. Although the formula is telling us, but if it's not going to add value to the analysis, we will not do it. And this shows that you are able to think outside of the box. You are not doing what the formula is telling you to do. You are using your own mind as well and thinking, is this even helpful? So in this case, you don't need to do average, but keep an eye. I leave it to you, and it will be a good assessment to see how you apply this discussion in your analysis. Did you do average inventories or you didn't do average inventories? The threshold should be around 5%. If the difference is more than 5%, then maybe. Because 3% in this case, if I do the average, it will become 1.5%, even less than that. So not really needed to do average inventories. So I'll take the figures from my 7.5 as my inventory days. And the same applies to the gross profit ratio. You may have already calculated ratios for your companies, and if your companies were service-based companies, they don't do gross profit, they don't have gross profit. Gross profit is generated when you buy and sell things. So let's say you bought something for £50 and you sold it for £80, your gross profit is £30. But if you don't buy and sell, for example, university, they don't buy and sell things to you, or airliners, they don't sell anything unless the small food we discussed last time, or phone service providers, they don't, or any other service providers, they don't buy and sell, they will not have gross profit. If they don't, you don't calculate gross profit ratio, and you should explain the reason for that. Even if they would have a tiny bit of GP because they sell a little bit, maybe food on the flight and stuff like that, you should not take that into account because it's insignificant to analysis. It's not going to add any value to your analysis. Cost of sales, folks. Cost of sales should be in income statement, but we looked at it last week and we know that it's not there. So we will go to note 3. Note 2 and note 3, and you can see that cost of sales figure is there. So we will use this figure. So we need to use days as well, 365 days. $43 days and 42.36978. So actually even this one is 42.86 days. So this would be rounded up to 43, right? What about this bit? 42.36. If you use Excel, it will round it down to 42 days. However, because it's a day, after 12 o'clock at night time is the next day. It's not today point 1 day or today point 2 day. It is tomorrow. So days are always rounded up, 43 days. So we can say that performance in this area is consistent. They managed to sell their inventory in 43 days, both in 2017 and 2018. Is it good enough? Is it quick enough? To understand that, we need to understand the business. There are two major areas of Marks and Spencer's operations: food sales and clothing. Food, fresh food, fruit and veg and meat, for example, should be sold within 7 days. Otherwise, it's too late. From that perspective, it's a lot more than that. However, the other significant area for their business is clothing. And if you think about the clothes manufacturers and sellers, they have a long supply chain. They buy wool and cotton when it is harvested. And they buy for the whole year in one go, because it's not something you can buy every month. When the time comes, you need to buy. So all of their inventory they buy and it stays in their warehouses. So that adds value to the inventory. If the value goes up, inventory days would go up. Then this is processed into raw sheets of clothes, and then those sheets go to the stitching. That's done, that takes time. Then it's shipped to the UK and everywhere else in the world, and then it stays on the shelf, and then it is sold. It takes a long time. So from that point of view, it's pretty good. So on average, it seems okay, but if you look at the competitors' data, Tesco is selling their products, their inventory days are around 30 days. So if you compare, Tesco sells very little clothing, so if you compare it, then it seems reasonable, but you should be comparing it with Next, Superdry, John Lewis, for example, to understand a bit more about what other competitors are doing in this area and to make a proper judgment. The next ratio tells us pretty much the same information in different ways. Inventory turnover, you can see that it uses the same figures, only in inverse way. So inventory turnover, which is cost of sales divided by inventory, and (8.5 and 8.6 times). So M&S managed to sell their inventory 8.6 and 8.5 times a year. The higher the figure is, the better it is. And to understand this, let's take an example of two businesses, A and B. Both started with £10,000. They buy products for 10,000 and they can sell those products for £15,000. So they make a profit of £5,000 every time they buy and sell. 50% margin. Business A can sell their products 12 times a year and business B can sell it 6 times a year. The gross profit for business A is 60,000 and for business B is 30,000. With the same amount of money, same gross margin, but because they can do it more, they can sell it more times, they're more profitable. This difference in inventory turnover could be because of the types of products they sell. For example, a fresh fruit and veg guy would be able to sell their inventory a lot more quicker than, let's say, somebody who sells crockery or kitchen utensils or stuff like that. But yeah, so but the more time you sell, the better it is. Now this is the most interesting ratio which we are going to do in this area, and that is trade receivable collection period. And I call it receivable days because it's easy and shorter. Receivables are my customers who buy from us on credit. The figure for trade receivable can be found in the balance sheet, and it is divided by credit sales. The problem is credit sales figure is never given in the financial statements. You will only have sales, revenue, turnover, but credit or cash, it is never given. So you as analyst, you need to work it out if the business sells on credit or not. Does M&S sell on credit? No? Yeah. If you go to M&S, they will not sell you on credit. They will take cash or card from you. And that is considered cash. So we can say that this ratio is not relevant to M&S. If they don't sell on credit, then we will not. Because if you don't sell on credit, you don't have receivables. Make sense? That's perfectly fine. If you don't sell on credit, you don't have receivables. So this ratio cannot be calculated. So you can decide, but I think there's one more test which should be carried out before deciding if this ratio is relevant for a company or not. And that is, if they have trade receivables in their balance sheet, then they do sell on credit. So let's check that out first for M&S. Going to my balance sheet, we can see that they have trade and other receivables in the current assets, And they also have trade and other receivables in non-current assets. At this point, we need to understand the difference between trade and other receivables. Trade receivables are my customers. Other receivables, anybody who needs to pay us money for any other reason. Maybe we have sublet part of our building, they need to pay us rent, they haven't paid it yet, that is other receivable. We have some money in the bank, they will pay us some commission, some interest on that, that is other receivables. Or we won a case against a supplier, they need to pay us penalty imposed by court, that is other receivables. So these are the few examples of other receivables. We need to ignore other receivables, only trade receivables. We have the figures, so what we should do, we should go to the notes 17 and see what is the real story behind these figures. And this is, whatever we're doing is proper research now. That's forensic accounting we are doing. So going to note 17 here. Trade and other receivable. So first thing, non-current, nothing is trade receivable. So we can completely ignore the figures in the balance sheet for trade and other receivables in the non-current assets. Then comes current, and we can see that there's a figure for trade receivables. If there's a figure for trade receivables, then they do sell on credit. So what's the story here? And you need to understand this whole story to calculate this ratio or ignore this ratio. First of all, they do sell on credit. If you have a credit card, M&S credit card, you use it, you become their receivables. You need to pay that money back to them. So this ratio becomes relevant, not so fast. Because majority of their sales are on cash and a little bit of their sales are on credit. And there's another note which could tell us if they sell on credit or not. But if this ratio is significant enough to be calculated, if you look at this data, 114.3 million pounds outstanding, customers need to pay us, and compare it with their total sales. So let's do a rough calculation here. What are we doing? We are calculating Payable Days. 114.3 million pound outstanding in 2018, and the total sales were 10698.2. That is 1% of the total sales. The receivables are so small that they are insignificant. And I tell you something very interesting. Most of the businesses who sell on credit, they make this provision, they make this estimate that every year they will not receive 3 to 5% of their receivables. It is very common. It's called provision for bad debts, people who are not going to pay us, irrecoverable debts. And if their total outstanding debts are 1%, that means it is insignificant. So this ratio is not significant for M&S, and you will see if you're doing a retailer, this ratio is not significant. You should not calculate this ratio and make a statement why you're not calculating this ratio, taking into account all of the things which I have just mentioned. And you will get higher marks for doing something like this. Instead, if you just calculate the ratio, which is easier thing to do, I could have calculated this ratio 10 minutes ago if I would decide not to take these things into account. But you will get higher marks for not calculating a ratio because it's not relevant, it's not significant, than calculating the ratio itself. This shows that you are not a machine, you are not a computer, you are doing whatever you're told to do. You are a manager. You can think outside the box. You do things only if they're necessary. But let's say this is significant. Let's say this becomes 5% or 10%. Your outstanding debts are 10%. Those companies who sell on credit, they will have around 10% of their debts outstanding at the end of the year. Then what do you do? Companies like Superdry, Ted Baker, Burberry, these are the businesses who have their own shops, so they are retailers. But they are also seller to M&S, John Lewis and other big departmental stores. For companies like these, and there are others, Apple is there, Apple sells to John Lewis, they have their own stores, Samsung does the same thing. So you will see this situation in many cases. In that case, you will have significant amount of receivables, so this ratio must be calculated. But this complication of how to get the credit sales figure. Companies like these would give you clear information in the segmental reporting. This could be note 2 or any other number, but the word segmental reporting is important. They would clearly give you retail sales and wholesales. You need to take wholesales figure as your credit sales and use that in the equation. So this is proper research work you have done in the last 10 minutes on how to find a relevant figure, and this is the only one of the most complicated ratio which you will be calculating. For M&S, this ratio is not relevant, it's not significant, but I will calculate it anyway. If you look at their segmental reporting, these are the two areas which could be on credit, franchisees, so they're selling those to the franchises, or maybe international revenue. If I do that, even because it's not significant, the debts are too small, so I'll just calculate, take the whole figure. I know it's incorrect, but that's the only time we are calculating this ratio, so I'll do it. So what do I have? I have debts of 114, should not be percentage, a number, 114 and 111. I'm taking the figures from here and divided by my sales, credit sales ideally. I don't have, so I'll take the whole figure. $10698.2 and 106.2 times 365 days. So result is insignificant. If any business is collecting money from their business customers within 4 days, that is brilliant. But they are very small. Actually, they're not receiving within 4 days. They're receiving in like 40 days. But because the credit sales figure is not available, it's not correct. So I would rather not calculate a ratio which is not reliable, not important, not significant, not relevant. The next ratio we are calculating is trade payable payment period, or payable days. Payables are suppliers to the business. All of the companies which you are looking at, they buy on credit. They don't buy on cash. That's the normal understanding, is that businesses which are selling directly to consumers are selling on cash, and businesses selling to other businesses are selling on credit. So trade payables are our liability, can be found in the balance sheet, and credit purchases would never be given in the financial statements. I made an announcement regarding this credit purchases, so if you haven't read it, it explains what you need to do when you're looking for a figure for credit purchases. In the class, quickly I can tell you that you can use cost of sales figure, but there's a bit more to it which you should read in the announcement. So trade payables divided by credit purchases. So let's do payable days. Trade payables. Let's go to income statement of financial position. Liabilities, trade and other payables. Note 19 and trade and other payables here as well. Note 19. Now we don't have note 19 for M&S here, but I know that all the other payables in non-current are other payables, and most of these are my payables. So I'll just take this figure, but you understand the process now from receivables, what you need to do to take the right figure for payables. If you simply take figures from balance sheet, that is fine, you will not be penalized. But if you take figures from notes, that will show that you have done extra work, and you'll get more marks in the analysis part, not in the calculation part, but in the analysis part. So I'll take this figure, 1405.40, 105.9, and 1553.8 divided by credit purchases, never available, but we'll take cost of sales. And we got 87 and 77 days. This result is within the range of the credit limit, which is normal in UK and other developed countries, 3 months. Business to business dealing is normally within 3 months. So they are paying their suppliers within time. That shows they have ability to pay in time. They don't have any cash problems. If they are not paying their suppliers in time, then it could be the reason that they don't have cash, which could lead to bad suppliers relationship or bad corporate social responsibility. Few years ago, Tesco result here were 180, and they were squeezing their suppliers with way too much, and the suppliers cried out. It became a big news in the media, and then they renegotiated the terms. Now they're paying them around 90 days, but higher these days are, this shows that you have more power over your suppliers. I think you are studying Porter's 5 forces, market forces, somewhere else, and that theory could be linked with this ratio, with also supplier receivables as well, that how your relationship are with your customers, with your suppliers, what is your power. If you're paying them after too long, that means you have too much power and you are abusing that power. Good for the business in the short term, but maybe not. And if you are collecting money from your customers too quickly, again, you have too much power over them maybe. And the other way around. So this is a good point to link your understanding from other modules with your analysis. The last equation is not a ratio. Operating cash cycle. Stock means inventory. Debtors means receivables. And creditors means payables. We already have these figures in our calculations. So we can calculate 43 plus 4 minus 77. And 40 to 30 days. OCC measures how long it takes to recover your working capital. So we talked about two types of capital in the previous classes: long-term capital and working capital. When you start trading, you start using your working capital. Most of that money goes towards buying inventories, which you would buy on cash or credit, and then you will do your activities to sell those inventories, cash or credit, and then the money will come back to you. So the OCC measures, let's say you spend from this pocket to buy the inventory, and then the money comes back to this pocket. How long it takes for you to do that? That is called operating cash cycle. The smaller it is, the better it is. However, negative means you never spend your own money to start the working capital cycle. You use your supplier's money, which is most efficient way of doing it. Maybe shrewd, maybe unethical at some point, but many businesses are doing, most of the retailers in the UK, they are doing that. They have a negative OCC, which is brilliant. So in that case, in this case, it has gone slightly less shorter, less negative, and this shows that maybe they decided to pay their suppliers a bit early because they had extra cash, or maybe their suppliers, especially if you look at the current situation in the last 2 years, the suppliers were feeling quite squeezed cash-wise. So many businesses would have paid the suppliers earlier so that they don't feel the strain of not having cash. Because if you're running a business, if your suppliers go bust, the business itself is in a big trouble, because then they cannot sell things which the suppliers were. So you will see this in your analysis. And in analyzing a business these days is really interesting, because you may be able to analyze what was happening before COVID, what was happening during COVID, and then after COVID. So this is a really good time to analyze a company. These are the 13 ratios which we teach in the module, and you should be calculating all of them if you can. If the data is not available for few ratios, that is perfectly fine. Actually, you can get higher marks if you can explain, justify why a certain ratio was not calculated.